Welcome to the Finimize podcast. I'm Carl Hazley. In this episode, I'm joined by Haig, Bathgate, Head of Investments at Atomos. We have a wide-ranging conversation, starting with what makes Atomos special, moving on to his forecasts for the US and UK economies, and then ending on what he thinks makes a good investor, as well as who he thinks the best investor in the world is. Let's get started. Haig, welcome to the Finimize podcast.
Hi there.
I'd love to start just by level setting our viewers, listeners who might not be super familiar with Atomos. So can you just give us the boilerplate? What is Atomos? What do you guys do?
Yeah, so the name Atomos actually comes from Greek philosophy, and it means indivisible. And when we were demerging our business from the old parent, Sanlam Investment Management, we had to come up with a completely new name. So we wanted something that sounded cohesive and something that would talk about bridging the two parts of the financial services industry that we serve. So we came up with Atomos, and it's certainly quite a unique name, I think.
Fantastic. And so Atomos is in the discretionary fund manager space, and that sets you apart from maybe some of the household names like Vanguard or Interactive Investor on the other side. Can you maybe tease out some of the differentiation between yourselves and some of those other major players?
Yeah, so I think the key differentiation is that we offer something that's very, very bespoke for our end clients. So if you go to a Vanguard, a BlackRock, some of those names, they're really, really good at what they do, but they're absolutely enormous companies. So they can't tailor things to their underlying client base in the same way that we're able to. We're effectively tailoring solutions for individuals who want to save money.
Got you. And maybe if I spend a bit of time zooming into the investment management side of things, what's the investing approach? What's the philosophy there? For instance, I've heard you speak about neutralizing style factors to drive consistent returns. How does that all work? How are you thinking?
Yeah, well, it was really good actually, because when I joined, I'd done a couple of similar jobs previously, but I literally had a blank sheet of paper, so we could sort of say, right, what does good look like, and how would we want to implement an investment process for the current day. And what we wanted to really do was bring some of the benefits you would get from someone like a Vanguard or a BlackRock, but tailor those inputs to individuals. So what we did is we partnered with a firm called Willis Towers Watson, who are more commonly known as WTW. They're one of the biggest pension fund consultants in the world. Look after people like Marks and Spencer's pension scheme, for example, and that allowed us to build something from the ground up, which was very exciting. Now, because they have such an extensive degree of understanding, I could take some of the principles that I'd learned over my 25-year career at that point, and it was like partnering, with a kind of weapons grade partner to implement some of those things. So that's where neutralizing things like style bias comes from. It's quite a technical term, but it's a way that we construct portfolios that are not sort of subject to the whims that you sometimes get in investment markets on a sort of day-to-day basis.
Got you. That's quite exciting. I can imagine tons of people would kill to be in that situation where, often if you come into a company and you've got a blank piece of paper, it also means everything else is blank and being built from the ground up, but you've managed to come in with that blank sheet of paper, put your ideas down, and then, in your words, supercharge it with weapons grade investment products and services from WTW. So that's really exciting to hear. Is it fair to say that's what gives you an edge versus competitors?
Yeah, I think so, because we don't have the legacy that a lot of our competitors do. So what's been great about this job, it's been very intensive, and we've been under sort of quite ambitious self-imposed deadlines to deliver this. But it has been great, and I've been able to have more flexibility to do things in this job that I didn't have the flexibility in previous jobs. So that's very exciting. And to be honest, working with someone like Willis Towers Watson, you never actually know how that's going to work in practice. But, they were really, really good people to work with. And actually, we've embedded them a lot more in our everyday operations than I would have thought it out. Saying, we're friendly with them, we hang around with them outside work. It's worked really well, and the symbiosis is, going from strength to strength.
Okay, fantastic. Maybe just to take a step back and think about the industry a bit more broadly. So, I started off by bringing in some big competitors that, as you rightly said, huge companies maybe can't do the bespoke work that you do, but maybe your more direct competitors might be the likes of
Mm-hmm.
Rathbones, RBC Brewing Dolphin, Quilter. I guess firstly, is that the right way to think about it? And secondly, what are those competitive dynamics like? How are you seeing the landscape at the moment?
Yeah, so like I think that's those are the people that we are competing with, absolutely. And I think where we're slightly different is, we've got a slightly more modern approach to doing things. It's like building a nav system yourself if you're a car manufacturer versus using Apple Play. So what we're trying to do is plug into the best wholesale providers. So someone like Willis Towers Watson, don't have much experience in terms of building portfolios for the likes of you and me and individuals. They're used to doing it for institutions and companies. But what we're able to do is to plug into their expertise. So they've got huge global might, but we can pick and choose the areas that we want to plug into. So we can bring things to our clients that I would argue that even some of the competitors you mentioned wouldn't be able to to gain access to. And because we've built this process from scratch, the classic thing is as you become bigger, you become slower and slower moving. But we've worked very hard to make sure that we can be nimble and that we can implement decisions really quickly, which is quite important in investment. I mean, that the lethargy and the latency sometimes when people talk about doing something versus actually implementing it can be very long. And there's a lot of nuances in the way that we've implemented this process, which I think make it quite unique relative to to those types of competitors.
Fantastic, and actually potentially a competitive
Mm.
advantage, I'd say, in the industry in terms of almost having the piece that slows you down is external
Mm-hmm.
to the core operations, and you can pull in the bits that you need, at speed.
Yeah, that's right. So we benefit from their economies of scale, but because we're plugging into it with, we've got our team, our investment team at Atomos is as big as it was before we engaged with Willis Towers Watson. It's just we're able to, pick and choose the bits that we really want to go for. And of course, this is very exciting for Willis Towers Watson as well, because it gives them an entree into, a sector that they have been serving indirectly, but not directly. So, so we get very, it's an exclusive relationship with them. So they did as much due diligence on us as we did the other way around. And it's certainly, it's going well, and the results are certainly coming through.
Cool. I mean, there's that age old debate, or at least it feels age old. In reality, it's probably barely even a decade old debate around, does the fintech scale faster than the incumbent innovates, and who wins in that David and Goliath battle? But actually, the answer is probably at least in your case, that both can win. You can get the scale in, they can have access to innovation and be at the forefront of growth.
Yeah, that's right. And I think there's two sides. This is the tech side of our business, which thankfully I don't have to do too much about, because that's the really, really difficult bit. And there's the investment piece. But a lot of what I'm doing is focused on how we can deliver the best outcomes for our clients, given a preset set of circumstances, and then how we can keep the clients on that journey. So what's the messaging we do around the investment? And of course, with the immediacy of information, it's quite easy for clients to get panicked because people see things on social media, and of course the only things that get a lot of traction are more extreme views. But investing in its true sense is 3-5 years plus. So a lot of what we're doing is sort of hand-holding clients through various periods. Just think the last 3 or 4 years, how much the world has changed, and interest rate environment's changed, and everything else. And most clients that we're looking after have 25 plus year time horizons. It's multi-generational wealth management over many generations. So a lot of our job is effectively holding the hand of the client and helping them understand what we're doing for them.
That's really clear. A couple of things there I wanted to pick up on. So I think my next question will be around exactly how you do that communication piece, because I think it's really interesting. The wealth of access to information, not all of it high quality, not all of it reliable. Reference social media, for example. But then you also talked about, the core of what you're doing is trying to help investors make better, more informed decisions and guide them through that. I guess, and the umbrella for all of this is that the entire industry is shifting. So you've got a ton of experience. We're going to come on to that a little later on. But, with your experience in mind and I guess your current hat on, where do you see the industry and your place within it going over the next, let's say, 5 years, but frankly, 5, 10, 15, 6 weeks, frankly, the speed at which everything's changing, who knows? But is the mix of what makes a good, investment manager, wealth manager, planner, is that all shifting?
Yeah, so there's a few things I think which are really important. You have to remember you're investing, not trading, and with so much information hitting you all the time, you have to have discipline in your process, not to be swayed by the immediacy of information. I mean, it's quite interesting. When I joined the industry, the advantage you would have by being a professional in the industry is you would have access to information other people didn't. And now the advantage that we have is we have tools that can sift through all the noise, because there's just too much information today. So a lot of what we're trying to do is slow things down. It's trying to take 3 or 5 year views about things, trying not to be swayed too much by, what the gold price is doing from this month to last month, or what the oil price is doing, and just really trying to look back in history, because history, has a habit of repeating itself. And also the way that humans behave collectively has a habit of repeating itself, particularly in extreme environments. So we're constantly trying to, kind of slow the process down, be considered in the way that we make our decisions, because there's no faster way to lose money than constantly changing your mind and, getting caught on the wrong side of things. It's also very expensive if you do it that way. So a lot of what we're trying to do is build a process that makes sure that we don't succumb to the behavioural biases that we all fall foul of.
Fantastic. So I guess as an investor, to me that makes perfect sense. I guess the natural question is, how do you communicate that to your clients? Because if I'm if I'm managing someone's money and I say to them what you've just said to me, that sounds incredibly boring.
Yes.
Which is good from a practical outcomes perspective. But, I pick up my phone, I see that Roaring Kitty has posted something on Reddit and GameStop has doubled. I see that Elon Musk has broken wind and Tesla stock has halved. I'm getting all of this noise, as you said earlier. And so having you tell me, we're deliberately slow and methodical and we don't want to deviate from our plan. And when everyone around me seems to be, chasing every headline, I guess, the $1 million question in a sense, what is the engagement strategy? How do you regularly engage with people, meet them where they are, yet come away having convinced them to eat their vegetables?
Yeah, I mean, it's a very good point, and obviously we want to get the balance right. So we should be boring in terms of the way that we're managing money, because this is in most cases people's lifetime savings. So we don't want to be speculating with the money. It's fine having a very small proportion of your overall wealth trying to move out in GameStop if that's what you want to do, but we're not going to have an edge in over anybody else. And I don't think anybody has an edge in that sort of stuff. So, it is, it's like going down to the bookies and, placing a bet on which horse is going to finish the race first. So, look, the communications that we're always trying to make to clients is just putting things in a longer term context. So we put out, weekly thought leadership pieces where we're covering big picture themes. Like what is the impact of baby boomers, retiring, passing on their wealth to the next generation? What are the implications of younger people not being able to get on the property ladder? These multi-year trends are the things that we're interested in. And of course, if clients want to have a sort of flutter with a small proportion of the portfolio, we've got some more speculative stocks that we can always suggest, but that would always be a very small proportion of the client's overall net
Yeah,
wealth.
absolutely. And I guess, frankly, having clients maybe wanting to have a small position in something super high octane in the grand scheme is a high quality problem, because I was reading in one of your weeklies that 60% of adults in the UK with more than 10,000 of investable assets, £10,000 of investable assets, have most of that in cash, or some large majority in cash, which is pretty alarming,
Yes.
especially with rates on their way down. So, why is that alarming on the one hand? Can you maybe just walk people through that? And secondly, I guess, what's the opportunity here, both as a saver, if that's who someone is who's listening, but then also, with your work hat on, what's the opportunity here for Atomos?
Yeah, so I think it's a good point, and it's an interesting stat that you highlight, because what that's telling you is people are scared to invest their money. I mean, if people are holding cash, it's obviously because they don't feel comfortable investing that money themselves, or they're worried about other people's ability to invest that money on their behalf. I think this is quite a UK phenomenon. If you look at the US are much more comfortable investing their own money and seeking advice. And I think a lot of it just comes from the constant barrage of information, and of course the things that are reported in the media are the bad days. Nobody sort of sits on BBC News and says, look, the markets are up 3%, isn't this great? They'll only talk about it when the market's down 5%, or when a company's blown up, or when a bank's blown up.
Yeah.
So that makes people inherently scared to invest their money, which is obviously why people should take advice. And the analogy we always use: imagine if someone was knocking on your door every single day, telling you the value of your house or your flat and how much that had changed. It would be thousands and thousands of pounds, for many people on a daily basis. That would really unsettle people. So sometimes this constant barrage of information is not, psychologically, is not good for people investing over a long-term time horizon. And then back to the cash point. Yeah, I mean, look, lots of people are holding cash and they're saying, well, why would I bother investing? I can get 4.5%+ interest rates and 5.25%. But you hit the nail on the head when you talk about interest rates coming down. You can buy almost risk-free government bonds on 1 or 2 year views issued by the UK government, that are yielding those levels. And if interest rates start to fall, you'll also make some capital gains, which for UK-based investors are tax-free. So there's always a time to take advice, particularly when we're going through these inflection points, like low rates to high rates. It always creates mispricing opportunities.
Yeah, that's fair. Let's maybe spend a little bit of time on a couple of those inflection points, and let's start with the UK, where we've come out of a recession. There's a slight uptick in unemployment, so inflation's there or thereabouts. So chances are we're due a Bank of England rate cut before too long. We're recording in June. Just for context, what's your outlook for the UK, I guess, rate situation, macro situation?
Yeah, so my view is that we will see interest rates. The Bank of England will not cut interest rates until they are absolutely sure they should be cutting interest rates, which means they're going to wait for confirmation, and that means the market is going to price it in before the Bank of England actually does something. And we saw exactly the same thing when inflation was starting to rise. They were very slow to start increasing interest rates, and they waited for the confirmation. Exactly the same thing will work in reverse. The problem with that is that interest rates always have a lagged effect, so it takes a while for people to feel the impact of their credit card debt increase, because it sort of compounds up. it takes average maturity of a UK mortgage is somewhere between 2 and 3 years. So it takes 2 or 3 years before
Yeah.
people have to remortgage. So there's a bit of latency in terms of interest rates rising and that having an impact on consumption. If you're going from having an interest rate where you set your mortgage in when we're in the middle of lockdown, uh, you're looking at a 5 or 6 fold increase in your interest rate, which is breathtaking. I mean, some people will have and this will have a material impact on their standard of living, and we're just starting to see these effects now. So I think the Bank of England will wait for confirmation, and then I think interest rates will be cut much more quickly than many market commentators are anticipating at the moment.
Yeah, I think that's fair. If I were a cynic, I'd say that the lagged effect isn't a secret, and that the country's finest economists sat in the Bank of England could have put a couple of charts together and figured out the lag.
You would think
But
so, yes.
I'm no cynic.
Well, that's the thing, isn't
Yeah.
it? I mean, and the other problem that we have is we've got the implementation of AI coming. I mean, that is coming, and
Yeah.
we've seen the investment already, and that is going to affect a lot of jobs at lower paid levels. Now there are lots and lots of people employed at lower pay grades, so you're going to have the impact of increased interest rates and mortgage refinancing and the like, along with the first wave of AI implementation, and that will precipitate an increase in the unemployment rate. So without sounding sensationalist, because we're talking about taking longer term views, I think we could be that the Bank of England might be forced to react quite quickly at some point later this year.
Fair enough. And of course, an election's on the way in the UK, July 4th. Is that something you're sort of advising people to adjust ahead of? Are clients coming to you sort of waiting, planning to do X or Y depending on the outcome? What's the mood really from the people you're talking to?
Yeah, we always have to be careful straying into politics, but if as looks highly likely, it's a Labour government. Actually, this affects more the tax planning side of our business more than, say, the investment side of the business. I mean, as much as we like to think the UK is very important on the global stage, actually, and overall stock markets or bond markets, it's a relative minnow. If you look at global stock markets, the UK is less than 4% of the representation of overall global companies. So it kind of doesn't really matter. So therefore, it's all on the tax planning side of things. It's what would the Labour government do? Now, Labour government's going to have to tread carefully, because obviously the general consensus is that Labour governments historically have not been very good at managing the economy. So I think all the mood music that we're seeing from Keir Starmer at the moment is that they've flagged in advance what they're going to change. They're not planning to do anything radical, and I think he will be. I think he'll be very keen to ensure that he's seen to be a good steward of the economy.
Yep, that's fair. I just want to pick up on one thing you said about just the relative size or importance of the UK in the certainly in stock market terms and in the economy. I'm finally glad I found somebody who won't be offended by me describing the UK market as an insignificant tiny island in the North Sea relative to the giant across the Atlantic that is the US. So, we're doing a bit of a whistle-stop tour on the macro. When the US sneezes, the world catches a cold. Let's just take the temperature there. We've got US inflation slowing-ish, the job market cooling off, retail sales have come in a little bit softer. We've just had manufacturing data come in a little bit softer. Same question, but with bigger implications. What do you reckon the Fed's going to do next? And how are you positioning for it?
Yeah, so I think the US economy is in a better situation than the UK economy. I mean, just generally, it's more competitive, and I agree with you. The UK in a global context is a bit of an economic backwater. The US, as you say, is not. Dynamics of the US economy have been much stronger. So I think the inflationary environment tails off more slowly in the US than what we'll see in the UK and Europe as well. Obviously, the drivers of inflation have been different in the US. A lot of it's been sort of more wage growth, whereas in Europe, it's a lot of it has been sort of energy price inflation and so on. But yeah, like I think it's the general trend is set. We're starting to see, as you say, more worrying economic indicators, which would point towards a slowing of the economy and possibly a recession later this year. Um, is that a bad thing for the stock market? Possibly not, because it signals that interest rates fall. But you have to obviously be very, very careful about which parts of the market you're exposed to. I think the big canary in the mine is fixed income markets. We've got so much debt refinancing next year, and if interest rates remain at the current level, then we're definitely going to see default rates pick up at a time where probably the economy is slowing, and that's something we're very, very cognizant of.
Okay. And maybe a final one just on markets is, how do you put this all together when you're sitting down with the clients? And I appreciate the work you do is bespoke, but I guess, to the extent you can share an almost house view, where are you positive? I guess multi-asset. How are you thinking about things?
Yeah, so look, again, the way that we try to do things, and this is through experience, we try to do things incrementally. So, the surefire way to lose a lot of money is to make, big calls, and then, kind of really move in a significant way. So everything that we're trying to do is incremental. So what we've been doing is we've been increasing our duration in the portfolios or our interest rate sensitivity. It was back when I first joined the industry. The interest rates were anything like the level that they are now. So even if it takes a while for interest rates to come down, if you're being paid 5+% to wait in the meantime, that's a great position to be in. So so we like long duration fixed income, particularly government bonds. We're way about corporate bonds because of the refinancing risk that we see there. And we're pretty constructive in markets. As I say, we tend to neutralize the style bias. So we're not taking a big view on value companies, which tend to perform well in higher interest rates environments, or growth companies that tend to perform well in lower interest rate environments. We try and neutralize that out, and just try and make sure we've got exposure to what we see as the best companies in both areas. But I'd say generally we're quite constructive, but very positive on the outlook for certain parts of the fixed income markets.
Okay, really clear. Let's shift gears a little bit. Let's spend a bit of time on you and your role. So you're head of investment at Atomos. Can you maybe give us a flavor of, what you do day to day, and where the overlaps are compared to your previous roles, 7IM, TCAM, and then again on the flip side, where are you breaking new ground compared to where the work you'd been doing previously?
Yeah, so look, on a day-to-day basis, obviously, managing the team of people who are making investment decisions. So a lot of what we're trying to do is spend time on portfolio constructions, make sure that the views that we have are actually being expressed in the portfolio in the way that we expect them to. Back to this point, a lot of people will give you a house market view, and then if you actually look at the portfolios, it's not actually represented anything like to the extent that they say it is. Yeah. So a lot of it is doing that, and then the other thing is making sure that we build a lot of risk controls around the process, so making sure that we don't succumb to our own behavioural biases, which even if we know about, are very hard to overcome. Being Scottish, I always like to think of the glass being half empty. So when things are going well, like they have for the last 18 months, I tend to get more worried almost than when things are going kind of badly, when we're suffering a period of underperformance. So, we sort of invert the charts and really think about, why, if things are working, are they working for the reasons we expected them to? Are we running the right levels of risk given the performance? And we put a lot of time into scenario analysis and just trying to rerun periods in history to make sure that the portfolios are performing in the way that we expect them to. In terms of the how this compares to the previous roles, very similar to what I was doing in a previous role at 7IM. The big difference at 7IM is they wanted to retain an internal team, so there was no scope to partner with someone like a Willis Towers Watson. So that's
Gotcha.
the big differentiator. And then TCAM was much more. It was a smaller number of families, so it was much more bespoking and had lots more kind of esoteric type investments there. So they're all quite different roles. But I've been able to use experience from each one of them to help me in this role as well.
Got you. Now, I think astute listeners will already know the answer to this, but to get everyone onto the same page, I will ask, what do you think makes a good investor?
Yeah, so introspection, I think, is the key thing. Always, always, always. There's a great book I was sort of rereading recently called Super Forecasting,
Yeah,
and that's just a great book because it's hard to be introspective, and it takes a lot of time using a different part of your brain, but it's so important. And many times the reason things work out are for reasons that you didn't initially anticipate, but your mind will tell you that it's it will reinvent history to tell you it was for different reasons. So having a rigorous process that goes back, is the only way that you can continue to learn. It's the only way you can say, right, well, I made that decision for these reasons, and it happened for a different reason, so you can moderate and improve for the future. So I think introspection is the most important thing, and reading lots and lots of books because you can learn from other people's mistakes as well.
absolutely. That's useful. Now, Haig, you've had a 25 odd year career so far. You lead people, teams, you've been led along the way. What, in your view, makes a good leader?
Yeah, so I think many people say this, but recruiting people who you think are smarter than you in your team is important. I think also younger people generally drive change. So I'm always trying to look for the future stars when I'm recruiting people. That's exactly what I've done with Atomos. A few of the individuals I'm working with here are, kind of, I think will be superstars in the future, and it's great. Yeah, I get a lot of personal gratification from that. Finding younger people, training them, giving them the confidence, and then in some cases seeing them going on to do bigger and better things at different places. I think we all learn every day, and I've enjoyed that. Enjoyed that doing it at TCAM. Enjoyed doing that at 7IM, and I've enjoyed doing that again at Atomos.
That's great to hear. Okay, so hey, we're almost at the end, but before I let you go, I want to kick off the lightning round. Short, sharp, fast answers to these questions, please. So, what was your first investment?
So my first investment was actually my worst investment as well, which was
Oh, okay.
a company called the Finsbury Technology Trust, which I invested in the sort of mid to late 90s, just as we were about to go over a precipice in tech bubble 1.0.
Oh, good. Okay. Well, because you shared your worst investment, I can ask you your best investment. What's that been?
Yeah, so probably my best investment is actually a direct share rather than a fund, but it's a company called Plus 500 spread betting firm.
Oh, I know
And
it.
yeah,
Yeah,
that's been a lot. I've held that for a long time, and the compounding effect of that has been brilliant. I think I'm up sort of 4 or 5 fold on that,
yeah.
and it taught me a lot of lessons along
I
the way.
Oh, it's high octane.
Yes.
I'll tell you that for free. In my previous life as a sell side analyst, it was one of the companies that I'd initiated on, and yeah, it was a wild ride to
Yes,
say
yeah,
that.
that's definitely goes in the
But yeah,
1% of your portfolio rather than the major part of it.
exactly. Yeah, luckily, yeah, I wasn't getting judged on performance. Directionally, I was right, but timing, well,
Yes.
you know what they say about timing. Are there investors out there that, or an investor out there that you admire the most?
Yeah, so like I mean, I'm going to be very boring and pick someone that most people will pick, but I just think what Buffett and Munger have done repeatedly over time, not just the discipline around the process, but the amount of money they're running, I think is just phenomenal. I mean, phenomenal. And, a lot of the principles we talk about, running your winners, and look at the position they've got in Apple, for example, and they've now obviously divesting some of that, but putting the principles into practice, I think you would struggle to find anybody who's as good as them.
Yeah, no argument here. Is there a piece of investment-related advice that you'd like to share that you wish someone had given you, 25 years ago at the start of your career?
Yeah, look, I think the key thing is related to introspection point, but you have to create an environment where it's okay to say that you're wrong. And if I look, when I've been restructuring investment processes or implementing investment processes in the past, the ones that have struggled most are the environments where people can't admit they're wrong or feel that that their position is weakened by admitting they're wrong. So the creating that kind of safe environment, which is it's an intangible, but that is the most important thing. I mean, you know this from when you were in the industry as well, that if you cannot cut decisively on the things you get wrong, those are the things that really, really hurt you. And it's not just the fact they hurt you in terms of their own performance, it's the fact that you could recycle that money into something else that would work. So I think the environmental stuff, the environmental aspects of an investment team are crucially important.
And last but by no means least, where can people find out more about Atomos and the bespoke work you do and services on offer?
Yeah, so we have a soon-to-be much improved website. I think it's atomos.co.uk. We also put out our content on LinkedIn. So putting out a lot of content. All the content that we're sending to clients, we publish also on LinkedIn. So those are the two main channels, I would say.
Fantastic. People can read more about the 10 million people sitting on cash in the UK that should be doing more with it. Cool. Haig, Bathgate, thank you so much for joining the Finimize podcast. It's been a pleasure having you on.
Pleasure. Thank you.